Awesome. Let me share my screen here. My plan is to present here, and I think everyone can see my screen.
Yes.
But I will also, I think if I can still see the chat, you guys could send questions in the chat, and then I can try and answer them throughout the meeting. I'll move the chat over to this window. So cool. We'll start with financials for fundraising. So this is me and my 2-year-old son. So like Ken said, I'm the founder of Zccounting. We work with probably about 140 startups now. And prior to starting Zccounting, I ran an angel group. And then prior to that, I worked for a lot of startup companies. I'm also a dad, as evident in this picture. So first off, when we're talking about startups and we're talking about fundraising, there's sort of every investor is looking for traction when it comes to funding a startup. And so what traction really means is that you've got a great team, so 3 guys that take in shot ski. Your product creates results, like whatever you're delivering on, and that there's customers that want your product. And so we're going to go through a couple different things a little bit structurally. I don't know what everyone's level is in terms of what their startup does or where we're at, but we're going to talk about the different forms of funding. So there's 2 ways that people typically raise seed capital, and those are debt and equity. Debt usually is in the form of a convertible note, and then equity is like selling a little bit of your company. So the convertible debt instrument is essentially saying, we don't know what our valuation of our company is today. We don't really want to go through issuing shares, but we want to provide you an instrument that will eventually turn into shares of our company at a max valuation. And so convertible debt is always a bridge to a future equity funding. And then equity, I put a picture of a nice Amish family here because I like to think of equity, raising equity, more like making Amish bread or friendship bread, opposed to cutting up a pie. And so when you think about equity, you start out with your bread, your sort of start, and then each time that cash is added, it's like adding more flour and water to your bread. And then as your equity stake grows and as the company grows in traction, your piece of bread will rise, or your piece of equity will grow. And then each time that they add more funds, it will grow the pie entirely, opposed to cutting out slices of an existing pie. There's another instrument that was started by Y Combinator called the SAFE. The SAFE is an agreement for future equity, a simple agreement for future equity. And a SAFE is similar to a convertible note, except for it's intended to be created without having to go to a lawyer, because both the convertible note and the equity round are quite expensive. So one of the things that you're going to have when exiting the company or raising funds is you're going to have to go through due diligence. So I like to throw up here essentially a format of what your typical due diligence folder would have. It's sort of best practices to create a Dropbox folder or Google Drive folder with all the pertinent information that an investor would want to see. And we'll go through in detail of what each of these sections are. Anyone want to do a quick screenshot? All right, we'll leave this available next time. So in terms of what you put in your financial package, you're really going to want to prepare what your startup has done so far, so your P&L and balance sheet, and then what your company seeks to do in the future. So that's your financial model, your unit economics, your cash and burn. And so profit and loss and balance sheet would come directly out of your QuickBooks. And then your financial model, usually that's built in Microsoft Excel. And then unit economics is essentially talking about when you sell your product, is your product alone profitable? Because in early stage businesses, oftentimes the profit and loss will be negative. So you'll not have positive cash flow or you'll have a burn, you'll be losing money as you grow, but you should be selling a product that has strong unit economics or will eventually have strong unit economics. So when you think about WeWork as an example, I think everyone's heard of WeWork and knows that WeWork lost $1 billion, right? WeWork can talk about their oldest locations that they're renting out are profitable, but the reason the company loses money as a whole is because they continue to grow and build new locations. The same thing as Uber. Uber lost $1 billion because they're offering a lot of marketing and promotion, but each single car ride for Uber is profitable because Uber is making 30% of the money that's coming in and the driver's keeping 70%. So that 30% means that it's profitable. So the other stuff that you're going to have to show investors in terms of the financial parts of the due diligence folder are essentially 3 documents that essentially say the same thing. So these are the 4 things that investors want to see. So the first thing is an executive summary. So the executive summary is essentially a written one-pager that talks about your business and the pertinent information that an investor would want to see. The PowerPoint deck that they're looking for is an 8 to 12 slide PowerPoint deck that goes through the same information that was on your one-page executive summary. The little guy in the bottom down here, he represents a financial model. We'll talk a little bit later about what should be in that financial model. But essentially the financial model, the PowerPoint deck, and the executive summary should all say the same thing. The 4th thing that every investor is looking for is lovability, like Taylor Swift. And when I first gave this presentation, Taylor Swift had no enemies, not even Nicki Minaj yet. But now she has a couple more enemies. But you have to be able to build a relationship with investors and potential buyers that essentially justifies why they would invest in you. A lot of people talk about creating a business plan. And some people say that business plans are something of the past. You don't need a business plan anymore. You just need to execute on your business. But there is a concept called the business model canvas that came out, which was essentially a one-page bullet point business plan. So I like entrepreneurs that I work with to update their business model canvas every couple months, because this will drive your assumptions for your financial model. It will drive your business to the value proposition, and it will drive essentially your way of thinking about the business. The most awesome thing about the business model canvas is if you have a couple founders and all 3 founders fill out the business model canvas and it says the same thing. That's actually never happened out of any of the companies I'm working with, but it essentially gets people to all talk about the same vision together. So in more detail about the executive summary, here's a format that I like of the executive summary. So you start out with that one-line elevator pitch: problem, solution, market size, traction, competitors, financials. And then in the upper right-hand corner, you see there's a little call-out box. I like to put all the pertinent information that your investors or potential acquirers need in your contact information so they know how to get a hold of you. So for the pitch deck, this is a great format for a pitch deck. I like to start a pitch deck with essentially 4 slides dedicated to why you're creating this business. And a lot of people say, oh, you have to start out your pitch deck with a shocking fact, or start out your pitch deck to draw people in. But what I like to do is essentially start with a specific problem, generalize that problem, a specific solution, a general solution, and then the specific solution. So let's take my business, for example. When I was working in startups, I had the hugest problem of explaining financials to investors. And when I was joining a company and was able to explain the financials, we got funded really well and the businesses did better. And then when I got into Techstars, I talked to hundreds of other startup companies and found out that our startups were not the only startups that struggled with creating their financials, and that once they put their financials together, got funded. So what I realized, and this is the slide 3, is there has to be a better way for entrepreneurs to put together their financials and get funded better. and that way is Zcounting. Here's a demo of how Zcounting works. Here's all the other information about your competitors, your traction, and financials. The team slide, I think, should look like a NASCAR car. So you should have the logos of all the people, because no one wants you to talk about your people and no one wants to read small font. So if you have the logos of where people worked, it shows that you've got credible people. And then I always want to tie everything back to why the investor should invest or why the buyer should buy by talking about your deal and the deal for investors. So in terms of the financial model, and I'm going through this pretty quick to leave time for others to ask questions. So going through the financial models, the more simple the financial model and the more easy for investors to understand, the better. And so I like to have essentially a 5-page, 5-tab Excel spreadsheet financial model, starting out with your assumptions, going into the ways that revenue comes into your business, so the cash in, going through all of your expenses in a single tab for the cash out, calling out your headcount of all the people that you're going to plan to hire, and then a summary that summarizes all these tabs together. A lot of people come to me and they say, we're a startup company. We don't know what our revenue is going to be or how to forecast for things. And so I like to talk about assumptions and validated assumptions. So when you're thinking about how do I know how much money I'll make, or how do I know what my costs will be, I like to think, create assumptions that are believable and validated if you can. So say, for example, the bottle of water has never been created yet, and you're a college student thinking of starting a company that sells water in bottles, right? For an assumption of bottled water, you could go to the library and you could research water itself, right? And how the body needs water. And you could find hundreds of articles about if you don't drink water, you'll die. And that the body is consumed of 90% water, right? And so you could make an assumption that for people not to die, they would pay $1 for water in a bottle, right? So that's a fair assumption. And I think if you had a bunch of resources that show that you die if you don't drink water, then you could justify that assumption that if you sell water in a bottle, people will buy it for $1. The other thing you could do is you could take cups of water and go out on the quad of your university, and you could essentially try and give away cups of water for free. And then talk to your potential customers who are taking these free cups of water and ask them if they would pay for them, and get their sort of opinion of how much they would pay for a portable vessel of water. And then, so that would be sort of a validated assumption. You gave away your product for free, and you asked people if they'd be willing to pay for it. So that could justify your assumption that people would pay, for bottles of water. The third thing you could do is you could actually go out there with cups of water, and you could charge a quarter, 50 cents, $1, $2, and see if people actually bought it. You could do that for a day and say, if we assume that 100 people bought a cup of water for 50 cents, if we just gave them a lid so we could deliver them more in a plastic bottle, people would pay $1 for this. And we know that because we tested 100 people bought a 50-cent cup of water. And so those are all 3 ways that you can create a valid assumption that's believable that could roll through your financial model. And when you think about other assumptions, you could think about, what would someone, if I needed to hire an engineer to build my product, you could go get quotes for engineers of what they think it would cost to build your product. If you, we're going to rent a space, you could go out and essentially review real estate, go get the pricing sheet for WeWork and use those as assumptions. So that sort of was a quick run through of the financials for business and that you need for funding and for an acquisition, and generally the financials that you'd want for a startup. And so I'd like to open this up for people to ask specific questions, and then I'll bounce back and forth through the slides. And maybe we could also talk about what are people's businesses that they're looking at getting funded today or that they're trying to exit.
So feel free to unmute yourself if you have questions. So, Andrew, I want to come back to, I'll dive in, but feel free other people to shut me up. You talked about several ways of raising money, the convertible debt, selling shares, and
First
SAFE.
equity, yep.
Yeah. I used my current company convertible debt, and it's coming back to bite me now because we've gone such a long time without converting it. And I think people need to be aware that there is, convertible debt was a wonderful thing when we started. But if you go too long, the interest can get to be quite substantial. I don't know if you've seen that with any of your client companies, but I'm here to tell you it can happen.
Yeah, so we've had clients that have had a 6 or 8% interest rate on their convertible debt, and they haven't been able to meet the milestones to get the next funding round. And the challenge with that is that within 5 years, that company owed the investors double what the investors had initially put in. And so when that company went to try and sell the company, they really couldn't find a deal that paid back the investors in full and also let the founders participate in the exit. And so what ended up happening there was the investors were essentially having to settle for less than their investment that they made, and the founders were having to settle for little to no money for the effort that they'd done, where all the money was essentially going to pay out the investors' convertible notes. The other thing is that if you go past your convertible note sort of conversion time, so usually they'll convert in, they want you to raise your funding round in 18 to 24 months. If you go beyond that, you have to go back to your investors and you have to ask them either for an extension or to voluntarily convert to equity. And when you go back and do something like that, it's an uncomfortable conversation to have with your investors, because some of them, if they don't care about your business, they'll just let it sort of, if they don't care about their business and they don't care about their money, they'll just sort of let it extend forever. But what you may end up running into is an investor that wants to take more control and won't let you extend, and essentially tries to push you to pay back their money earlier, which is kind of worst case scenario for a founder who didn't meet their milestone and is not able to raise that next round to convert. So yeah, convertible debt, I think if you're able to get a fair valuation in equity, I think you should always take equity at a valuation that you believe in, beyond convertible debt, because then you know exactly the dollar amounts and you don't have this debt sort of hanging over your head, accruing interest.
Right, but then the trick is, of course, to get a fair valuation and not have a valuation that is so high that you scare off
Undervaluing your
investors,
effort.
and so low that
Right.
you end up with another company. But I think but those are questions that, as a founder, you run across every day. Every question is like that. Are we doing the right thing?
Right.
Can you talk about record keeping and what people need to do? I mean, you briefly mentioned your QuickBooks, but I suspect that a lot of people, in fact, don't keep adequate records. How often have you seen this when you're getting ready to sell a company, you have some kind of excerpt that the company doesn't have solid enough accounting that it runs into trouble?
I mean, that's really tough, because when you're building your company and you're really busy writing code and selling customers, the last thing you want to do is spend all weekend doing your accounting. But we come into a lot of clients that had filed tax returns based on sending bank statements, and they just called everything that came in revenue, everything that went out sort of general expense. And the problem that happens there is you have such poor records that your potential buyer can't tell where the money had gone and what it costs to run the business after they acquire the company. And so your valuation is going to be really beat down, and you're going to have to pay a lot of money either to your own accountant to help clean up your work. We're actually working on a merger right now. There are two companies, one that was bootstrapped and one that had investor funding, that are coming together because they were sort of doing the same thing. And and the company that was bootstrapped never did their accounting, and they're trying to value, you know, how much should the founders of each team get of the new combined company, and they have no financials to go back and do that. So we're charging them to do about 2 years. We're charging them about $3,000 to go back and clean up the past 2 years of their books, so that they can even get to a point where they can have a conversation about, you know, what is their business worth? Because the acquiring company had been doing clean books their whole time, and it's just hard to figure out, you know, whether we integrate these, are you guys overpaying or underpaying for expenses? So that becomes expensive. I think when you start a company or at any time, you should open a QuickBooks account, because QuickBooks is relatively cheap. You should sync it with your bank account, and then you should, if you can, do your books on a weekly basis, or if you just don't have time to do it, outsource to a company like ours or one of our competitors. I think that, you know, working with someone like us, and I don't want to be a sort of an advertisement, but we've got a lot of experience with startup companies and with what investors are looking for, and we're set up to essentially on a weekly basis touch every account that we have on our platform, and make sure everyone's accounting is up to date as of the, you know, the prior week at least. But also, you know, on a small scale, it's not super hard to do, to use QuickBooks. It's designed for people to be able to do themselves.
Hi, good evening, everyone. My name is Nancy. How are you, Andrew? Thank you for your talk.
Hey, thanks, Nancy.
So I have a startup, and it's interesting because your example is about water. So my startup is water recycling. But sorry, and I also don't have a camera on my computer, because when you're a startup, you try to save everything, and I never thought I was really going to need it. So that's why I don't have my picture there, and you can't see me. So
yeah,
I'm not
problem.
hiding from you. I don't have a video. But I wanted to ask you two important questions. What do you think about financial advisors that kind of are interested in helping me with getting this going? And then the second thing is, you've talked about convertible debt, so that's kind of like one of the choices. That's the bottom choice that they gave me. The top choice was debt, traditional corporate sponsorship, or private. And they explained it to me once, but I kind of just, there were too many things to remember. So private debt, I kind of understand, but the traditional debt, the corporate sponsorship, can you tell me what the differences are? And then the equity, it seems intuitive, but they have earned equity, straight equity, and private equity. And then, of course, the third choice was the convertible debt. So anyway, really the two questions, which is, what do you think of those financial advisors for startups? And then the second one, if you want to take the debt, the three different types. Thank you.
Yeah. Yeah, so I think there's only one financial advisor you should talk to, and that's no, I'm just joking. I think that it depends on how the person is compensated, and what their intentions really are. Yeah. So one of the difficult things that, and I ran an angel investment group, and the reason why I don't run an angel investment group, and I'm actually starting up another angel investment group. We just had our first event before this whole COVID thing. But the problem with angel investment groups is we're doing it because I have a customer base that needs it, and I want to give back to the community. So we're not charging any fees or doing anything. But a lot of these angel investment groups survive by charging the startups to pitch, charging the investors to be there, and charging sponsors to attend the events to make business. So if you go to one of these events or one of these networking and you meet someone like me or one of my colleagues there, that's paid a large $5,000, $10,000 sponsorship fee, they're going to be looking to get paid really quickly. And I think that it's a trap when someone says that your accountant or financial advisor will be the one to help get you funded. I think that especially at seed stage, the investors are really investing in the founders and the founding team
Mhm.
more so than they're investing in your financial person, your accountant, or even your traction at that point. And so I think be careful, because the sexiness of someone helping you get funded and getting money into your business
Mhm.
is alluring and compelling, but the reality is that it may or may not actually be helpful. I think at later stage, we've got a couple of clients that have been hit pretty hard by COVID. Their businesses has done okay, but not as great as they'd like it to, and they're just sort of burnt out. I think that at that, and that now they're trying to sell their business. So, you know, they do a couple million a year, which is enough to sort of sustain, but no one's getting rich off of it. So they're working with a financial advisor, like an investment bank, to try and find potential buyers to acquire the company, or at least the assets. And so I think that those type of advisors, when you have a real, you know, going concern business that's making a couple million a year, I think that bringing in those type of advisors is valuable. But I think at seed stage and early on, there's so many free resources around town to learn about financial modeling, to learn about accounting, to learn about, you know, what investors are looking for, that, you know, and there's probably some great people. I can name a handful of people that I think do a great job trying to help startups. But there's also ones that I think are taking advantage of startups. So a lot of the programs that Looney Lives of Pledge was doing down at the Impact Hub, a lot of the programs at the Impact Hub, I think were geared toward really helping founders figure it out. And I think that those were really valuable. A lot of the stuff that comes out of Keiretsu, to be frank, I feel like is focused on people taking advantage of startups to make money off of them. So the other thing is there's different types of equity. I think that in early stage businesses, all of the equity that's purchased in that company is a private equity security. So, and then there's sort of a couple different stages, but most traditionally, if you're a C corporation, and you start with, let's say you had 10 shares in your business, and you're going to sell 2 shares to an investor, what you would do is you would issue 2 new shares. So your total pie would be 12 shares opposed to 10 shares. So it's not like you're giving away 2 out of 10. It's like you're adding 2 more to the top to sell to that or those investors. So so every time that you raise a round, you're essentially giving away, you're issuing 20% more shares and selling those new shares. And then you should only sell parts of your company to accredited investors, meaning really rich people that make over 200 grand a year as an individual, 300 as a couple, or have over $1 million in assets that are not their primary residence. And the reason you'd want to take accredited investors' money is because they can afford to lose it according to the SEC.
Right.
And so they're allowed to invest in those type of companies. If you are to essentially start a company with someone that's not accredited, and you guys are both going to invest 10,000 or 20,000 of your own money and build the company together, that's another sort of way that you can start the company. But at that point, you're both contributing to the common stock of the business. I think that going into more of the types of debt and equity and funding maybe would be better offline if there's a specific question you're trying to modify. But there's just so many different variations of these vehicles. But the most standard ones are the convertible note, more and more the SAFE, which is the simple agreement for future equity, and then the equity in the format that I described, where you would sell an investor new shares that you're issuing for your company.
Okay, I'll probably email you too. More questions.
Yeah, for sure.
All right, thanks, Andrew.
Yeah. I'll throw the email up there.
Yeah, so if no one else is jumping in, can you talk about, you hit a particular nerve with me of people and angel groups that are taking money from startups that don't have money to give. You know, I have a real problem with certain angel groups, and you know, I will provide my advice for whatever it's worth for the price of a cup of coffee or lunch. I'm not going to charge people for it. But a startup company does need some real advice on how to set up their books, how to follow the laws, learn what an accredited investor is and why you want to do it, and stuff. Where do you think is a good place for someone who has not done this before? Maybe they're putting together a team, maybe they're a technical person who has a good idea, or maybe they've got a team already with someone who's who could manage a company, but maybe they haven't done the startup. Where do people go to learn without being ripped off or overcharged for this?
So
besides your
I don't want to say anything. Yeah, I don't want to say anything bad about angel investment groups. So, no, I'm just joking. No, so I think, you know, the idea of an angel investment group was really the concept that there was a matching, there was a problem with matching between entrepreneurs with ideas and investors looking to fund companies. And I think that 10 or 15 years ago, that was definitely the case, that it was hard for entrepreneurs and investors to connect and talk about building businesses. But I think with technology today, these teleconferences, meetups and stuff like that, a lot of the problem with finding investors is less of a problem than it was before. And I think that a lot of these angel groups are doing fun events or social events to try and find more companies and try and attract more investors that you could totally attend, and they're nominally priced. Like Karitsu's like startup, they do some huge startup event where there's a bunch of companies that have booths and there's a bunch of investors that watch seminars. Like going to that event, I think is really valuable and fun, and you can meet a lot of people without having to pay exorbitant pitch fees or join as a member. So I think that there's some good stuff there. Where I would go today, assuming that I didn't know myself, but where I would go today is I would look at New Tech Seattle, and then what's that? There's that other group that's that they do the 90-second pitch over 10 companies. Nick Hughes puts it on. There's a couple meetup groups, and I would look at the GeekWire calendar and Seattle Tech calendar. There's a couple meetup groups that essentially have a bunch of entrepreneurs that are like a first look forum. So really early stage, sort of the first time that startups go out to pitch. And I think that's a really great place to start, because I know a lot of investors. There's actually an investor that every time that I've attended Nick Hughes group, I forget what Nick Hughes group is called. It's not New Tech, but it's the other startup one. But every time I've been there, there's one investor who was the first investor in Yahoo that's worth over $100 million that attends these events all like socially, just like he's one of the kids wearing a hoodie. And he's there just scouting for cool entrepreneurs and cool ideas to invest in. And so I think that going to the meetup groups around town and just building relationships with people, maybe even before you need the funding. I mean, like this meetup group, North City Tech, I'm sure that there's a bunch of people that are building relationships and helping each other out and referring to other friends. It's also great to find people that someone else has worked with already, and you can tell if they're a good guy or gal just based on the other people's experience too.
Is Nick Hughes, is that Founders Live?
Founders Live, that's it.
Interesting. I've never heard of them. I have to check them out. Yeah.
Yeah, Founders Live is a great event. They do 90-second pitches, and then there's a big vote over who's the best pitch. And his goal was to essentially get 100 people to pay $10 a month to attend his events, which I think is just a great model, because it's a real nominal fee and $1,000 a month over a couple of locations. They have them all over the world now, something like 50 locations. And then I've actually tried to push Nick Hughes into starting a venture fund, because he's seeing all the deals all around the world before anyone else. So it's I think his event's really great. He sort of took what New Tech Seattle was doing and took it to another level.
Can you just
There's
talk
also
about,
one called like A Million Cups, and there's a handful of other ones in other cities too.
can you talk about the one that you're starting or involved with?
Yeah, so we started an angel group called Nomics, and I run a meetup called Cigars and Startups. So Cigars and Startups came out of, I'll zoom way back. So back in 2012, when I was running an angel group, it really felt like Shark Tank, and it had a really negative environment. And everything that I could do to try and help support the entrepreneurs was sort of undone by this constant chasing for more sponsors to fund the payrolls of the group. And so the big problem is when you had to get payroll paid to host big lavish events, you had to charge everybody something to put on an angel investment event. And so one of the things that I thought is we needed to have an event where it was just chill, where people could, you know, get together, talk about startups, but there wasn't the pressure of the Shark Tank. And my premise was correct. Cigars and Startups has grown to about a 1,300 person mailing list. And once a month up until coronavirus, we got together at a bar and smoked cigars. So the thing that Cigars and Startups did really well is this whole social thing, and investors would come and we'd have an investor sort of pitch why you'd want to go pitch their fund your startup idea. And so that was sort of the idea with Cigars and Startups. But over time, as my business grew with accounting for my clients and Cigars and Startups kept building relationships with more investors, I realized there needed to be an angel group that was a little bit more formal than smoking cigars at a bar on a Wednesday night, but less formal than something with a whole bunch of employees and pay to pitch and all these sponsors choking your throat. And so we created Nomics to help educate investors about various categories that are coming out. So AR VR right now is an interesting. Sorry, I've got an Amazon Echo in here that announces around the whole house. But yeah, so AR VR, for example, is a category that not a lot of local investors understand well, and they're not sure if this is a good investment or not. And so our goal with Nomics was to essentially bring in an expert who's invested in AR VR or someone who's exited an AR VR company to talk about the metrics of that investment, and then present 4 or 5 AR VR companies that are raising funding. And so for the investors, they get to learn about the concept, and then they get to see 4 or 5 opportunities to invest in the concept. And so we thematically, we're going to go through, you know, AR, VR, women founders, go through, you know, maybe a blockchain event, maybe one about retail, and bring some of the best investors we could find in those categories, and then the 4 or 5 best startups that we could find in those categories at various stages. And so that was sort of the concept that we've gone out to market with. And the idea was, if you put great entrepreneurs after a great speaker that tells you how to invest in those entrepreneurs, you can get people to invest in more companies in Seattle. My goal is to help support the community and help support my clients. I don't really have a profit motive in my angel group, which I think is a great thing for the founders and for the investors alike. We want to just cover the costs. So we might take on like 1 or 2, like 1 legal sponsor, something like that. But yeah, so that's my angel group.
How does it be? How do people get involved with it or present or?
Yeah, so we're trying to figure out how to do an angel investment event over Zoom, but really we just all the platforms were difficult, and with all the various PPP and crisis stuff, we decided let's just put it on hold until we can all get back together in person. But I guess we have a website, Nomics Capital, so spelled like economics, Nomics Capital, and we've probably got a mailing list you can join there. Otherwise, we're going to promote it on the Seattle Tech calendar and the GeekWire calendar. So if if people just keep checking that, hopefully you'll see it. Yeah, I wish I had better information, but we currently don't have any more events planned because of the crisis.
All right, thank you. One thing that I've noticed that during this crisis, a number of angel groups where you normally couldn't attend or you'd have to show up in person, I've been able to attend on the Zoom meetings, and which I like to do just to see how other entrepreneurs present, and how angel groups react to them and stuff. So if you are an entrepreneur and have a chance to attend an angel group meeting well before you're ready to present to one, I highly recommend it so you can see how other people do it. And angel groups vary quite a bit on what they let people see and do and so on. But it's a very good thing to do.
Yeah, I would absolutely agree. And even when I had founders that, you know, met Keiritsu and Keiritsu was asking them to pitch, I highly suggested to them to attend a couple events before taking the jump to pitch. There's a couple questions that have come in through the chat. The first question is, how does one compare the investment opportunities in Seattle versus Silicon Valley? Should an entrepreneur consider moving to Silicon Valley to get better success? So I'd like to point out that the two largest companies in the world are based in Seattle, Amazon and Microsoft. And so I think that there's something in the Seattle water that creates really huge, successful companies. The problem with our ecosystem is that a lot of people made a lot of money working at a large company opposed to starting a company. And so they're more risk adverse, and they're in the idea of essentially retaining their money and conservatively trying not to lose it, opposed to taking risks and gambles. It feels like in San Francisco, everyone made a little bit of money working at a startup or selling a startup early or investing in a startup that exited. And so it feels like in San Francisco, everyone's playing with the house money. And so there's a lot more free-flowing funding. I think in the question of should we move to San Francisco or should we start a company in Seattle, I think that it's really telling that all of the large San Francisco startup companies, Google, Facebook, you know, and pretty much every company, Uber, they all open engineering offices in Seattle once they've gotten big enough to afford to be able to do it. I think that starting a company in Seattle is a great place to start a company and sell a company because one, we don't have a state income tax. So you can pay people 30% less, and they're actually more wealthy living here than they are in San Francisco. And two, when someone joins your company in Seattle, they're dedicated to your company, and they don't have a shiny new startup across the street offering free Teslas. And so I'd say there are a lot of reasons to start a company in Seattle, but I would also say there's a lot of reasons to get connected in San Francisco to the community. So I think that the best way to really engage in the San Francisco ecosystem is to join an incubator in San Francisco, but then come back to Seattle to really build your company. So, so then another question in here is a little bit about the Zccounting business itself. So we've sort of gone to market 5 or 6 years ago with a $500 a month basic bookkeeping package. So we do full service. We essentially went out to market with full service bookkeeping at $500 a month via QuickBooks. We now today describe ourselves more as an outsourced accounting department. So we still have the bookkeepers, but we also do everything from payroll to bill pay to taxes, K1s for partnerships and 1120s for corporations, and then using that sort of accounting@yourcompanyname.com as the sort of way that we're getting all of our information for our clients and helping them execute on their accounting goals. So hopefully that answered the question of what we do. We do everything from essentially hosting QuickBooks and doing your bookkeeping all the way up to coaching companies through exits and mergers and venture rounds.
Do you do tax prep too, or is that something you outsource?
Yeah, so it's interesting. A lot of our clients, especially if they have sort of Series A money, their investors want them to use a large accounting firm for the tax return. You know, spend 2 or 3 grand, maybe 5 grand on a tax return. And we have a great working relationship with all the large firms in Seattle, and a lot of our clients are happy that our work is reviewed by another sort of set of eyes, as in the large tax firms. We do have some partnerships with other firms that feel more like you're working directly with our team for some of the more exotic things that tax preparers and CPAs would do. So we have a group that does R&D tax studies. We have groups that do valuation, 409A and otherwise. And so some of that stuff is done in-house. I also just met a guy in November that we essentially decided to combine forces, and it was a sort of pseudo acquisition. However, the tax season started really strong this year, and then with COVID, everything sort of got put on hold. And so we don't have a formal tax preparer on staff, but we've got, he's sort of not fully on the team because he's still operating his own business before the merger, but we can definitely take care of all tax needs.
Thank you. Yeah, I have an accounting firm. When I lived elsewhere, I didn't know about you, but and then I also hire one of the big companies to do our taxes each year, and it's expensive,
Yeah.
but you know it's going to be done right. I think there's another
Yeah,
question
you know,
here.
and in some cases, yeah, in some cases we found the big firms don't really give the startups the attention that they need, and there are a lot of errors that come out of that. If they're just sort of plugging and chugging and putting associates on your work, you really need someone to sort of make sure they're paying attention. So so yeah, I'm seeing another question coming in. That's easier. How do you suggest we look at things? Andrew, why don't you just read your question out loud so it's not me trying to read. What's your question, Andrew Bushnick?
Hi, Andrew. Can you hear me?
Yep.
Cool. Yeah, so my biggest question is just when going through forecasting, like we are pre-launch, so we don't have any real insight into things like days payable outstanding, days sales outstanding, pretty much our turnover. So I'm just kind of thinking, is it safe to assume something like 30 and 30 just to keep it simple? Because we really don't have any insight for that.
So you're asking, your question is about an assumption for your financial model?
Yeah, just kind of from your accounting, I guess, perspective, just kind of, is it safe to make, simplifying assumptions like that, like just assume 30 and 30 so things are super easy and you don't have any real issues with like net working capital as you flow through your like cash and everything else? Because if we're trying to get like burn, ultimately, if you just set both equal to 30, you theoretically don't have any real change there. That's going to be necessary for like net working capital. So it's like kind of zeroes it out.
Yeah, if you're talking about the balance sheet and what's your equity and stuff. Yeah, I think that the more important thing the most important thing on your balance sheet is really how much cash your business has and how much cash you're burning. And so really forecasting accruals into a financial model around depreciation and accounts receivable and accounts payable is really just overkill. And so I think really the simpler the better is my advice on financial models. We do build a 5-year financial model that people have complained is complex, but we try and keep it as sort of simple and easy as possible. So yeah, I think that the more simpler you can make it so that the investor understands your business model, but then can focus on why your business is great opposed to why you're making assumptions, I think is a better model. I'm seeing some more questions over here. There's a Maurice asks, what's the best way to provide equity to founders? And I would say that that's probably a question for a lawyer, but we like to see all the founders in the business having some part of their equity on a vesting schedule. So there's either a buyback for a penny per share if the founder leaves to incentivize the founders to stick around. Investors will typically demand that the founders have some of their shares investing. If you're adding, so in the example that you have two co-founders that each have 50% of the company, have a portion of those shares be granted, so they own those shares, and a portion of those shares be earned over 3 or 4 years. As you're hiring new employees, I think that employee stock options or restricted stock units that are also vested over a period of time, 3 or 4 years, is also a great way to incentivize early employees and founders. Does that answer your question there on equity to founders?
Yeah, that's good. Thank you so much.
Yep. All right. So the next question that someone wrote is advice on forming C Corp versus LLC or other forms. A C Corp standard for investors. Also, where to form. Some people say Delaware versus others say Washington. So the corporate formation question, again, is a really great question for a lawyer. But from my perspective, if we're working with a company, we want them to look like the last investment the investor funded, and we don't want to have to answer questions around why we did something different than the standard. So I'd say that the standard is a C corporation with 10 million shares established in Delaware, and that's what the investors are going to be most comfortable with, and that's what they've seen before. I had a recent founder who created their corporation in Wyoming, and they believed that the tax benefits in Wyoming were better than the benefits in Delaware, and they were happy to talk to investors about why they picked Wyoming instead of Delaware. I think it's kind of a waste of time to be focused on corporate formation opposed to focused on selling your business, but for them it was something that was really important to them. I think if you're starting a C corporation that you think is going to be profitable pretty quickly and you're not going to need a lot of outside funding, having to do compliance in both Delaware and Washington, if you're based here, is kind of a hassle. So if I were to start a company, and I would probably only want to start a company that didn't really need investor funding, because investors are, their own set of challenges that makes running a business that much harder. I think that I would just do a Washington C corporation. The reason to do an LLC or S corporation opposed to a C corporation is that you think that your company will be profitable and throw off cash that you want to distribute to your shareholders. So if you're taking outside investors with an LLC or a LLC filing as S corporation, all of the profits of the business you have to pay tax on all the profits of the business on your individual tax return. So on an LLC, the corporate entity is simply an entity, not its own entity. It's like just a legal format around the income that the individual shareholders make. Whereas the C corporation files its own tax return, and it's not required to distribute its earnings to the shareholders until it decides to produce a dividend. The other interesting thing is if we've got a lot of clients that are venture capitalists in California that have established Washington management companies for their essentially venture capital management company. And the reason that they do that is because the corporate tax rate in Washington state is only the federal tax rate of 22%. So if you make $1 million, you pay $222,000 in tax, and then you're done and you can keep as much money in your corporation. Well, you can keep a reasonable amount of money in your corporation longer term. But to get the money out of the corporation, you have to pay the dividend tax rate, which right now is pretty cheap. It's anywhere from 0% to 15% to 20%, depending on your tax bracket and how long your money's been in that corporation. So if you're going to make money and your business is going to sort of support your lifestyle and you don't need to take a lot of money out of your business, I highly suggest C corporation. If you're going to take investors, I think you almost have to do a C corporation. If you're starting a small business, the LLC is way less complex, and it essentially makes you have to distribute all the profits every year to all the shareholders. And so I think that's a great business model too. So I think if there's a specific question about a specific type of company, I'd be happy to answer that. But I think in general, investors like Delaware C corporation.
I just want to jump in there and say that Washington State is just about as good as Delaware, because we have so many software companies here, including certain big ones. I've never had any pushback for us being incorporated here in Washington State, and it's easy and it's close. So I think just either go local or go Delaware, but Washington State works.
I'd agree. So there's a question here. How much of an appetite is there in the market for financing retail-related startups, especially in health and nutrition? This is for growth plans for a small business growing in the health and nutrition space. So I think, so I had an entrepreneur come to office hours that I was doing at the UW a couple years back, and she was an entomologist that wanted to start a business related to bugs. And she posed a similar question. She said, Andrew, she had me eat some cricket chips, toasted crickets and whatever. And she said, Andrew, do you know any investors that would want to invest in a bug company? I'm tired of doing research and I want to start a company. And my answer to her was no, there's absolutely no investors that want to invest in a bug company. And I'd say the same thing. There's no investors that want to invest in a retail related startup, especially in health and nutrition. Investors don't generally just want to invest in an industry. If you're going to just invest in an industry, buy a publicly traded company because they're safer, there's a lot of reporting on it, and you can look at a lot of transparency on financials. I think that what investors want to invest in is an opportunity for them to buy a winning lottery ticket. And so, and they want to have some assurance that their lottery ticket's going to win. And so if you have a startup that with a little bit more money can grow exponentially and give returns to investors, I think investors would be interested in that business. The hard thing about retail is that there's high capital expenditure costs to create the retail plan to build that company. So if you're selling software, all you got to do is roll up another server on Amazon, AWS, and you've sold your next customer. So selling an additional customer is almost free. In retail, you're constrained by the people that can access your retail space, and you're constrained with the capacity of your retail space. And so I think that it's easier to fund and grow an online software business opposed to a physical business in the physical realm. That being said, there's been some great companies that investors have made a ton of money on that are physical. One great example up until about 3 months ago was WeWork. WeWork was a totally physical business that essentially was taking retail space and reselling retail space. And that company grew to a valuation of $40 or $50 billion, creating essentially a retail-related startup that posed as a software company. So, Ashwin, hopefully that answered your question. I'm going to scroll back up and see if there's any other questions that I missed.
This is great. I'd encourage anyone who has more questions to come up with them. I'd also encourage people to join as many meetups as possible and just talk to people. One thing that I did when I was raising money for my current startup in a different location, I was fortunate to be a accredited investor, and so I joined the local angel group, got to know the people in the group, and then when I was ready, I was able to get the people to invest in my company because by then they knew me. Now that may or may not have been a good decision on their part, but it did work for me. But I do want to add one other thing. When you are raising friends and family member money, and Andrew, maybe you could talk a little bit more about this. When I did it, I told people I'd rather have your friendship than your money. If you're gonna write me a check, it has to be money that you could just roll up into a cigar and burn, because this is a startup and anything could happen, and most of the time, all bad stuff is going to happen. Now, when you're raising money from angels, they know what they're getting into. When you're raising friends and family, they should still be accredited investors, as you said, Andrew. But even then, you can't, family is right there. You can't get rid of them. And friends, I'd rather not get rid of. So my personal advice is, sometimes you have to go to friends and family because angel groups are more risk averse than they've ever been. But make sure that they really know that they're pissing money your way. Andrew, you want to address that a little bit more, perhaps?
Yeah, I'm an accountant and I'm not that interesting, so I have no friends. So that's not really a problem my business is faced with. No, so I happen to live in West Bellevue, and one of my neighbors over here is a guy named Jeff Bezos. And there's a rumor that his parents never owned enough of Amazon to be major holders in any reporting, but they're like the secret 50 billion billionaires, right? And so if you're Jeff Bezos and your parents want to put 100 grand into your business to own a couple percentage points early on, and you end up becoming a billionaire and didn't give them the chance, that's kind of sad, right? Also, famously, Mark Zuckerberg's dad invested in his startup and made a boatload of money. Probably the same thing with Bill Gates' dad, right? And so when you believe in your startup and you've got traction and you're sure you're going to make your family money, I think it's fair to allow them to invest in your money, in your startup. I think to Ken's point, taking friends and family money first before getting outside validation from other investors is a really dangerous thing to do, because your friends and family will be inclined to support you. And if you talk to someone enough, I think Bill Clinton famously proved this. If you tell yourself a lie long enough, you'll eventually believe it, right? And so if you continue to tell your friends about how great your business idea is, you may unreasonably convince them that it is a great business idea when it actually isn't. And they may invest unknowingly in your startup, and then you're going to have some really awkward conversations to have. And so I know some founders that won't take any family money or any friend money and only want to find outside investors. The other hard thing about that is when investors come and try and invest in your company, they say, well, why have none of your friends and family invested? And so I think that in every scenario, taking money from friends and family is very difficult unless your friends and family are super rich and don't care about the money. But it's still, you're going to know that you took their money and either paid it back or didn't pay it back. The other problem, I had a friend who was a VC, and when he started his VC fund back in, I think it was the early to mid 90s, one of the startups that they invested in was a company called F5 Networks. And he essentially told his dentist, he said, hey, I have this venture fund, we're investing in a company called F5 Networks. Do you want to throw in 25 grand? And his dentist said, sure, it sounds like an interesting company, I'll put 25 grand in. And that 25 grand ended up turning into $8 million, and the dentist retired. And so asking your dentist or your doctor to invest in your startup is also a very dangerous thing to do because if you're successful, you may lose your dentist. If you're not successful, you might lose them as well because they might not want to be your dentist anymore.
That's a good story. Thanks. I want to add something else. This is my personal opinion. When you start a company, if you're starting a company that requires an investment, you are automatically insane, because whether it's 90, 99%, whatever the number is, percent of those companies are going to fail. And yet you believe that you're not going to be one of them. You're going to be successful. That automatically marks you as insane, because you're divorced from reality. Because you're probably going to fail by the odds, but you've got to believe otherwise. Andrew, in your experience, are you seeing, do you want to put a number on the percent that fail, or do you think that it's perhaps more positive than I'm representing it?
I think I have a different perspective on failure in general. I think that today, with the information that we have, with the ability to build technology super cheap, I don't think that any startup should fail. I think that the difference between startups should be a sustainable lifestyle business or a venture scale business. And I think you should be able to figure that out before you raise outside money. Today, if you're a software engineer, you can go to Amazon and get $5,000 worth of free credit from Amazon. You can use Stripe to process credit card processing, and you can, spend a couple bucks, $8.99 a month or whatever to launch a website on GoDaddy, and you can literally put your product online and start making sales immediately. And so if you're able to do that, I've got a lot of these guys. We work with a lot of companies where it's a couple guys out of Amazon that are really smart guys that write good code, and they'll go out and they'll start a business and they'll sort of bootstrap it with some of their Amazon stock. And I had a particular client, that they created a new way to parse resumes and to optimize recruiting. And so they were essentially creating a recruiting agency that didn't that used AI to review the resumes, so that they could have one recruiter manage, reading 10,000 resumes a day. And what happened was they created a business that did a couple $100,000 a year. All the founders were taking home, sub 100K, but probably pretty close to it in salaries. And they got to a point after doing this for 2 years that they said, hey, we need help shutting down this company because we don't see that it's going to be a venture scale growth business. And so they chose to shut down the company and sort of let it fail because it wasn't going to grow fast enough. So I just think that you should do whatever you can. John Seacrest is a guy around town. He runs Seattle Angel Conference, which is also a great event. He's got this sort of idea that if you start a business, you should find someone to pay you $1, and then someone to pay you $10, and then someone or some people to pay you $100, and then grow to $1,000. And you should sort of baby step your company with various levels of seriousness of your startup. And I think that his model is a really great model. And if more people went out and tried to build, this revenue stream from day one, and actually validated their product, or as much of their product as they could create, they would be a lot more successful businesses.
Yeah, thanks, Andrew. We've had John present to us, and he does a good job with the Seattle Angel Conference. I'd recommend, if you have a chance to hear him talk and to attend the conference, that's a good thing. I personally am interested in companies that are doing something beyond just another cloud-based business, that want to take bigger leaps with technology. But that are far more risky. So, but you're absolutely right that if you have the skill set, you can do an awful lot with an awful small amount of money nowadays. It's really, up until a few months ago, it's been the greatest time to start a company ever. Now it's no one knows. No one knows. Great. Other questions? In that case, I think we'll start on wrapping this up. I have been recording this, and I'll place the recording on meetup.com in the next day or two. Andrew, if you could either shoot me the slides or put them up somewhere where I could reference them, I'll put a link up on meetup.com. And I want to thank you all for attending and not being zoomed out. I find that I'm on more meetings than I've ever been in my life right now during the quarantine, thanks to Zoom. And next month, again, it will be on a totally different subject. Get plugged in with electric cars, learn all about electric cars. Feel free to start discussions on the meetup.com. As I think I kind of hinted at before, I've been through the Zccounting a couple of times, and I'm always happy to give my own totally biased advice for the price of a lunch or a coffee, or in this case, a remote lunch or coffee. I really have a problem with people who exploit entrepreneurs, as do some angel groups, but not others. Thank you all for attending. If you have, I'll leave it up for another minute if there are any last questions. Andrew, thank you very much for your time this evening. I thought that was very interesting and well done. Thank you. Otherwise, we will see you, I hope, next month. Stop laughing, Jonathan. Okay. Thanks a lot, everybody. Thank you, Andrew.
Thanks, guys.
Okay. All right. Over and out, everyone.